Hey, Renter Retires. It's Adam Schroeder here with another episode. I am joined today by Tony Lopes. He is the CEO of Dirty Boots Capital, and we're going to dive into what's going on in the real estate market. But Tony, thanks for joining me today.
Adam, thank you for having me on. Before you click the record button, we already started having a great time. So this is going to be a great recording. I'm really looking forward to it.
Yeah, so let's go with the first question we ask everybody, and that is, what was your first real estate deal?
So my first real estate deal was for actual cash flow was a quad. I bought a 4-unit building in the city center, Class C building. I get asked the question quite a bit, like, what was the cash on cash, and what was this metric, and what was that metric? And I was like, I wasn't smart enough 20 years ago to be running that math.
That part didn't run through my head.
It didn't. It was purely like how much cash flow per door is really what I was looking at. That was my metric. And it's one of the things I share with folks. Don't get wrapped up so much in the metrics and the numbers. And, obviously you got to make sure it works, that, you're not going to end up in the poorhouse or lose the building. But, what's important to you? For me, it was cash flow per door. And it was, I was trying to get $200 per door. And so this one did, close to 1,000. It met my metric of $1,000 a month extra in my pocket each and every month after all the bills. And that was sexy for me at that time. And so that's why I bought it.
Now, you mentioned the first one for cash flow. Were previous ones just like primaries, or were you doing wholesaling, or what were you doing there?
Yeah. So when I graduated from college, I ended up buying a condo. And so that was really the thing where I did some sweat equity on it. It needed a certain amount of refresh to it. So I bought it low and was able to add some value to be able to sell high, so to speak. But that was my vehicle to do a HELOC at one point to pull some cash out to be able to buy the quad, right? That was my, my piggy bank, so to speak.
Yeah. So let's move forward a little bit, because it sounded like that first quadplex went pretty well, but I'm pretty sure if I had to go out on a limb, I would say that at least one deal hasn't gone the way that you thought it was going to go. So let's go a little bit forward to your first deal that didn't go right. And then how did you manage to keep yourself focused on the game? Because we see so many investors, they have a property, a tenant does something to it, or water main breaks or something, and they're just like, man, I lost money on this deal right now. I'm out. I'm done. I don't want to feel. And the thing I remind them is, look, you have a stock account and it goes down 50 grand. You're not crying because you're like, I'm just going to keep holding it. It's not real. Well, if you have a real estate property and it has 2,000 in repairs, you feel that. That's real.
Yeah.
Immediately. But you need to keep looking out longer term. So what was your first hiccup, and how did you continue over it?
Well, fortunately, I didn't have a major hiccup. I wish I had a real sexy, salacious story to tell you, but I don't. But I will come at it from the perspective of that first quad that I bought. So I'll share a couple of stories that maybe folks can relate to. That first quad that I bought it for $300K. And like a year later, it was like, I'd be lucky if I could sell it for $250. And I think 2 years after I bought it, I would have been lucky if I could sell it for $200, right? So I bought it wrong. I bought it high. It was my first one, and I totally, screwed it up as far as the purchase goes. But the point being, so I still own that building today. The development rights with it. There's a lot of goodness that's associated with it. So we're looking to take it from a 4-unit to an 8-unit. The bureaucracy that surrounds it with the government planning officials is, nothing less than a show and a clown show in terms of trying to get things approved through the city. But there was a lot of goodness with it. But the point I bring that up is because it stresses the point why I buy properties for cash flow first, right? I never buy a property based on, I think in a year, 2 years, 5 years, it's going to appreciate over time. And that's really when I'm going to get my payday, is after it appreciates for some amount of years. Because we never know. We never know what's going to happen. And had that been my game plan for my first quad, I would have been in a really bad situation because it actually went down in value. But I was sitting there. Fortunately, I was sitting there saying, I don't care. I don't care that it went down 100K in value. I was cash flowing, and I'm not in the game of real estate to just trade properties, from one day to the next. I'm not a day trader for real estate. And maybe that's a podcast there, a separate podcast idea.
Day trading real estate.
Yeah. Yeah. I don't advocate that because I would have been in a pickle there. So that's one scenario. Fortunately, it didn't go bad for me, but it could have had I been like many people are looking for today. They're just looking for that appreciation. They think it's going to be, 2020, 2021, 2022 all over again, where it's just constant appreciation. The market doesn't really work like that all the time. So that was one scenario. Another scenario was, me like other folks, I've had evictions that I've had to deal with, and sometimes they go well, other times they go off the rails. So you have to plan for that as far as, contingencies, much like we have a CapEx account, for certain things we want to plan for, a new roof, whatever it is, a new porch, refreshes on units. We have a CapEx account. You need to make sure you squirrel some away for when you have a rainy day with the tenant and things don't go well. Fortunately, I was already at the point when I hit that speed bump, I already had enough units and I was cash flowing well enough such that my other units were throwing off enough cash flow to be able to float me through those hard times. So,
yeah. I always tell people, you can look at that appreciation play if you want to, but you have to be honest with yourself whenever you're doing it and say, this is what I'm doing. This is why I'm doing it. And, are you willing to take the hit if things go south? It's something you got to just be honest with yourself and don't just say, I'm doing this and sure, my plan was this. Just acknowledge what you're doing, right? I mean, that's one of the important things is being truthful to yourself and admitting this part is a gamble. I've got this over here, and the appreciation play is a gamble. It could work really well. It could not work really well, but you just gotta admit what you're getting into the day you get into it. So
yeah. And one of the things, I'm a huge advocate for is, just having a good network to talk to other people about your deal with, just openly and honestly, and kind of like share some numbers. I had great folks I could share my numbers with, and I knew they weren't gonna. Nobody's gonna steal your deal, right? I mean, this industry is the only one that I know of where people will actually help each other to do well in it, right? You go to a conference, a real estate conference, and people are asking, oh, how are you doing your marketing? Where do you list your apartments? How do you deal with this? How do you deal with that? And you see it all over Facebook as well, right?
Yep.
There's a whole bunch of different places, and everybody's trying to help everybody do real estate better, right? Be a better investor, right? Now, you compare that with as I say, the pharmaceutical industry. If you go to a pharmaceutical conference, if you're in that business, do you think people are going to be sharing their best practices with you? No, they're competitors. But real estate and investing in real estate isn't like that. Everybody's, for the most part, like 99.9% of what I see out there, people are helping each other and not kicking each other in the teeth. So share your numbers, get somebody else's perspective on the deal. And in that, if it comes out in the conversation that you're buying it solely for appreciation or for some other reason, or, you're forecasting like way high on your numbers, maybe that's something somebody else needs to help you with, kind of think through a little bit and add some reality to that. So, having a good network to share that with is important.
It has constantly astounded me whenever I talk with real estate investors is how open they are about everything. I mean, like they will, and I will too. I find myself telling people like my literal financials that I had in the deal. It's like, yeah, this cash flows this much in my life. Like you were saying, it's one of those things that just kind of happens. I don't know what it is about them, but the investors inside it are very, very cordial with each other.
Yeah.
And
Yeah.
it's one of the few industries, and I say it can be a win-win-win-win-win situation where, your flipper, your builder makes money on theirs, and you get a good asset, and your tenant gets a good place to live, and your mortgage company gets the rates that they need for their investors, and your property manager gets a door to manage, your home insurance company gets a home to manage, and literally, what was that, like 6, 7 people right there walking away happy from a deal.
There's money for everybody, right? I love it.
So what are you seeing? I mean, you do coaching. What are some of the big things that you're telling people now that you weren't a few years ago, as they look to get into the real estate game, or maybe they're looking to expand their portfolio a little bit, but they're still thinking, they're probably still thinking, based on what a lot of people are saying, of, man, it's not the same as it was in 2020 or 2021. So how are you talking to people and coaching them differently now than you were just a few years ago?
Sure. So the number one thing that has served me well and allowed me to really buy multifamilies and retire at the ripe old age of 44 years old, which I bring that up not to be braggadocious. That's not my purpose. But, real estate is, one of the few ways where you can get to retirement. The purpose of this podcast, we're into retirement. You can get to retirement like pretty reasonably quick, right? So one of the things I share with folks is, like I just shared, never buy a property unless it cash flows, right? If it doesn't cash flow, don't buy it. So we got to be sure on day one, it's going to cash flow for people. The second thing, or another thing I share with folks is today, because of the high interest rates and because of the high cost of the cost of money and the cost of properties, today you have to mentally be prepared to come to the deal with more money. Okay. Because if you come in with, 10, 20%, even 20%, a lot of deals are not going to pencil out. It's just where we are today in time in the multifamily space. So you just have to upfront be prepared, figure out a way to come to the deal with, 30, sometimes 40, and sometimes 50%, depending on the property, 50% equity. It's just the way it is. So we got to figure that out with folks. And then, one of the other things, some folks who already have properties, we've seen rents go, double-digit increases for the last 2-3 years. And that's abnormal. That's not reality. And don't do that to your tenants. Yes, take them up where it makes sense to take them up, but, have empathy, right? Have empathy with people in your lives, not just your loved ones, but also with your tenants. Understand they are being affected by inflation just like you are. If you have to take it up, have a conversation. Don't hide behind an email. Don't hide behind a text message or however you do your increases. Like for me, I will be on it. I call, and you may think this is crazy, I personally call each and one of my tenants. They know me. We have a relationship. I say, John, I'm sorry. Inflation is happening. You're feeling it. I'm feeling it. Let me tell you, here's what I'm saying. My property taxes have gone up. My insurance has gone up, blah, blah, blah. I'm not here to cry to you, but this is part of the business, and I do need to take you up another $100 a month or whatever it is, right? I've had to have those conversations with folks. So, man up, so to speak, get on the phone, have courage to have those phone calls. Don't be a wimp and stand behind an email or something like that. Your tenants will respect you. Your tenants will respect you enormously. I actually have had a couple of times over where I've had to go up on tenants as much as, believe this, $400 a month. $400, that's a lot. They are still with me today, because I share with them, how do we work through this? I understand. I could give you a 30-day notice and a $400 uptick, but I'm not going to. How do we make this work? Do you need 60 days to kind of figure those finances out? And what if I give you 60 days and we only go up like $100, a month for 4 months in a row? how does that work for you so that we phase into this, new higher rent? How do we do that? You be part of the solution here too. I don't want to just, kill somebody with an increase. So have empathy, have that relationship with your tenants, and it's going to serve you well, because we're going into a time and place where, I'm seeing more and more people having evictions because tenants are like, they're done with it. They're done with these increases, and it's killing them. Along with the rest of every other piece of inflation they're feeling. So, don't be part of that gang where you just continue to go on those rents. Have some empathy. Go up where you need to, but work with your tenants, and you'll be well respected, and it'll go well for you.
I cannot imagine all of my tenants having my phone number. And that I love my property managers, because I do not want that as part of my life at all.
Yeah, there's definitely a fine line, but there's they know, again, it's a relationship, and they know, if they need to put in a work order or they have some other issue, I'm not the right person to handle that quickly for them. They know they have to go directly to property management, but when it comes time to like really, talk about the finances of things, it's something that really, really impacts their life on a daily basis. I think it's important to have some of those conversations. Maybe not every single one like I do, but some of the more meaningful ones with tenants you want to make sure you keep. Maybe there's some tenants you don't want to keep that maybe you send the email, maybe you send them the email, but the other ones that you do want to keep. And all my tenants are awesome. I have awesome tenants, and I do want to keep them all. And they all do have my phone number, which many folks may not, resonate with, and that's okay. That's okay. But I have an awesome team that backs me up and supports me. So that's why I can do it.
How has your investing strategy changed over the years? Like, I'm assuming at this point in time, you probably look at metrics. Hopefully you're looking at metrics in some form or fashion, as opposed to just, hey, look, shiny object that'll make me $200 a month. So how has your investing changed over the years?
Well, in a couple of ways. So, because of inflation and the cost of things and the cost of buildings going up and the cost of money being more expensive, one of the changes we've made is we partner with others on deals. That's a change that I made, I don't know, maybe four years ago, because with bigger apartment complexes, more units, we can amortize the cost of things over many more units than we can on, say the quad, right? That first quad that I bought. If I need to put a new roof on that, I can amortize that cost over 4 units. Well, if I, buy a 30-unit building, I can amortize the cost of that new roof over 30 units, right? So the same thing with property management, the same thing with insurance costs, and on and on. So we feel like we can provide a better service and a better product by going in and purchasing larger apartment complexes. We just did one. We partnered with a couple others, and we purchased 153 units in an apartment complex. And the reason for that is because we can get those efficiencies and that economies of scale, and it results in just better returns, more realistic returns back to the investors, safer, less risk for the investors. And so it's a good thing all around. Kind of like you were saying, there's with some of the deals you guys have done, everybody walks away making money. And that's what we're looking for. So we're doing bigger deals. That's one of the things we're doing. And we're also investing in, specific places we believe are going to have future long-term growth. Places like Florida and Arizona have been two of our bigger ones because, people are getting older. They're retiring. They move south. Florida, Arizona have been yeah, for retirees. There's other places. Those, those are two places we feel, particularly good about, right? So when you look at the statistics of what's actually happening out there for people moving into Florida, for example, there's 1,200 people a day. Last time I looked, 1,200 people a day moving into Florida, right? They need to live somewhere, right? They're not going to go live under a bridge, I guarantee you. So we want to provide that product, that service of providing them with clean, decent apartments, and so that's why we're down in Florida. That's something that's changed in the last few years for us.
One of the things people do get worried about, as you say, is the market analysis part. What do y'all look at for market analysis? I mean, obviously population flow is a big one, but what are some of the other things that you recommend to people and that you do personally as you vet out a market?
So we look at population size. So for example, in Florida, Jacksonville is the largest. I think they're close to a population of 1 million people, right? You want to make sure you have a good source of potential clients, right? You don't want to buy in a city or a town that just has 2,000 people. You don't have enough supply of renters there for 2,000 people to push your product of an apartment. So you want to make sure you're in a place where there's plenty of people. So we look at that population and population growth. So we like Jacksonville, we like Cape Coral, places like that. We also like places that we look at building permits, starts and completions, and kind of see where that is. That's kind of like almost like a crystal ball, right? We don't have many crystal balls in real estate field or in life, right? But building permits, starts and completions are a pretty good indicator as to where a particular market is going. So I think, just speaking of Florida, I think we looked at something in Tampa, and then which was, it was great, beautiful building, looked great. But then we looked at that crystal ball of permits that were being pulled for the next 5 years, and Tampa's just going to get flooded with units, and we were really concerned that was going to push down the future rents on our potential complex we were looking to buy. That was going to push down rents on ours, and kind of risk the returns we were speaking about to give to our investors. So
Way too many phone calls, right?
Yeah, exactly. So
rent drops.
Yeah, we didn't look there. So that's the sort of stuff we're looking at. And I encourage folks that, we look at some demographic stuff up north. We've looked at charts that, we look at the 10 to 15-year-old demographic, and folks will say, why are you looking at 10 to 15-year-olds? Well, we look at that because in 10 years,
they get older.
Our renters, right? 10 years, they're going to be renting from us, right? And if the chart is downward sloping, saying there's less and less 10 to 15-year-olds, then that's not a good sign. We probably don't want to invest there. It's, not to say it's not a bad place to buy a single family home or, live there. I'm not saying it's a bad part of the country or a bad city. I'm just saying for us, we're looking for sweet spots. We're looking for places where, the chart is going, up. Some of these places, looking at demographics, we can tell where we want to be.
You talk about the crystal ball that you're looking into. So whenever you're looking at the starts and everything, what are you gauging? Are you just gauging it against the past or comparing that to the population growth, or how do you use those starts as a crystal ball?
Yeah, so with Tampa, it was pretty easy. They had in 5 years, they had 100,000 units coming to market in 5 years. And you look at the current absorption rate of those apartments. If it's hey, they can absorb 100 I don't remember what it was, but if they're absorbing 100 apartments a month, you just run the math, and it's it it'll either feel good or it won't. And for us, just running that math looking at the absorption rate, the historical absorption rate, to your point, we do look at some of that history and say, will it get better? Maybe, because there's more people moving to Florida. So maybe the absorption rate goes up some, but we're relatively, on the lower side of risk, and try to not really be too aggressive with saying, well, the absorption rate's going to double.
That's kind of like banking on appreciation, right?
Yeah, right. We don't bank on that. So absorption rate is one of the things we use to take a look at whether those apartments being built can be truly absorbed over a period of time where we're looking to hold that property.
Now, if you had to look into a different crystal ball and tell us 2 years, what do you think the real estate world looks like in 2025, 2026?
I think for the most part, it's going to look very similar to what it looks like today. Come down some. And so prices are sticky right now. There's a lot of folks who are, still looking at pricing and wanting to sell their building like it was, 2021, 2022. We're not in that time anymore. So I think the prices are going to stay sticky. I think the rates are going to come down some, but that's not going to really, that shouldn't really impact the deal, right? I mean, if your interest rate comes down, 0.5%, and that's make or break, maybe you shouldn't do that deal if it's that dependent on a 0.5% rate change. So yeah, I just see it as being sticky. There's the thought that, obviously Donald Trump is the front runner from a political standpoint, and that's probably a good sign for interest rates to come down further in the future. So if you ask me, like, where will they be in 3 years? I think they'll be lower in 3 years than they will be in, say, a year. So I think the real estate market has legs. We're in it for the long haul. If rates come down, say we buy a property today, like we just did, 153 units, say interest rates come down enough where it makes sense for us to refi, we're going to refi, right? There's always that option. So if you buy for cash flow and the rates go up and you're already locked in at a certain rate, who cares, right? Who cares what happens with the rate? You're cash flowing. You're making money. Your investors are happy. You're happy. If the rate comes down, don't sweat it. Just refi, run the numbers, make sure it makes sense to refi, and just refi. Don't sweat it. Don't get all like, anxiety over it. I mean, that's why we have these options available to us.
Yeah, that's what I always have to remind people is, look, the day you buy is really the worst day of your investing journey, because after day one, you have no control over what your interest rate is, very little control over price and rents and all this, that, and the other. But after day one, when day two comes around, it's up to you to decide when the deal changes.
Yeah.
And so you're not going to change it if it makes it worse for you. And whenever it becomes better for you and it makes sense, then you just go in there and say, hey, I want to change the deal. And for some reason, the bank just goes, okay, let's change the deal. Right. So it's there for it. So let's get to Dirty Boot Capital. Tell us a little bit about what y'all do, who would actually benefit from using your services, and let's wrap it up with that.
Sure. Thank you. I appreciate you, Adam. So, we do a few different things. So I'm on the speaking circuit. I go out there, I talk at different conferences, events, and RIAs, and whoever wants to hear me, babble about things. I talk about whatever is happening in the world. We do study it quite a bit. So it's important. So we do some speaking. You might see me around. Other than that, we do coaching. We truly believe real estate is a way to create wealth, which is the conduit to greater freedom, right? Which I'm just hugely a fan of freedom. I talk a lot about freedom. That's why I got into real estate. I didn't get into real estate, and I share with others who want to get into it, don't get into real estate to create a second job for yourself. That's not why we do this, right? We do it to create cash flow, to create wealth, ultimately to create freedom, to do the things we want to do when we want to do it, because we want to do it. That's why we do this, right? Not to go around and post Lambos and unicorns on Facebook. We don't care about that. We really don't. We just want to create wealth and freedom for ourselves and for our families. So we offer coaching for folks that are interested in doing some one-on-one coaching. We don't do group coaching, none of that. Really, because coaching is just so specific to somebody's personal needs and where they are in a particular time and place. Some people will gravitate towards fix and flips, and that works for them. Others are multifamilies. Others, they want to get into, Airbnb. So everybody has a different purpose in life, which is okay. So other than that, we do syndications. We're actually starting our third fund to be able to most likely continue with a partner we've been partnered with in the past, doing great things. And so, yeah, we're starting our third fund to help investors get, again, into a good situation that's cash flowing, that's passive for them, right? Not everybody wants to be an active real estate investor, and that's okay. I get it. But if you want to be in real estate and achieve the benefits of cash flow and appreciation, and don't really want to study the market, where to invest those dollars in real estate, that's what we do, right? And so if you want to ride our coattails, then get in touch with us, and we help people from that perspective.
All right. And hey, nothing wrong with riding coattails. They still get you there, right?
Yes, sir.
All right. Well, the website, again, for everybody out there, the website is dirtybootscapital.com. That's dirtybootscapital.com. Tony, really appreciate you joining me today to talk about all of this. To everyone else out there, don't forget, you got to get started sometime. Don't be afraid of the world we're in now, because just accept it for the way it is. Get yourself some assets that make sense for you today, and they will continue to make sense for you in the future. And if you have any questions that you want Zach or myself or any of our guests to answer in the future, please email podcasts@renttoretirement.com. That's podcasts@renttoretirement.com, and we will answer them in upcoming episodes. And as always, don't forget to go to renttoretirement.com, schedule a time to talk with any of our consultants. Also see the inventory we have out there if the turnkey model is for you. That's at renttoretirement.com. Really appreciate the time you spent educating yourselves today. Talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.